Jay is back on this Millionaire Mindset Plus YouTube channel, and I haven't posted on this channel for about 8 months now. From today, I'm going to be posting daily videos on how I make money online, and specifically documenting my journey, how I'm making money on the Forex, indices, and stock markets using a strategy that I've been using for the last year. And I'm going to be doing live trades. I'm going to teach you how you can read the markets. As most of you know, I've got my main channel, Millionaire Mindset, where I teach other ways to make money online, like drop shipping, affiliate marketing, drop servicing, e-commerce, building funnels. Whereas this channel, I'm purely going to be focusing on trading and documenting my journey there. So what I want to talk about in today's video is how I make anywhere between $100 and $1,000 a day on the Forex and indices markets. Using the strategy, I've had up to $5,000 days, but I'm going to make it a more realistic number for you guys maybe just starting trading or not having as much as capital to start off with trading. And I'm going to narrow it down to, let's call this the $100 a day trading strategy. I'm going to show you all my tips, secrets, and tricks that I use to identify the markets, place the perfect trades, and I'm going to refine down on entries on how you can get over 10 RR, risk to reward ratio, when trading. So this is a video that you don't want to miss. Now I know it's weekend, so we can't go and trade live today, but we can do back testing. We will test the strategy on replayed markets. It's one of the best ways to practice trading is on the weekend and back test your strategy on different markets. So that's what we're going to do today. So the first thing I want to talk about is market structure in the eyes of institutional firms, such as big banks investing billions of dollars into the market, or big financial institutions that are investing and buying and selling billions of dollars in all the different markets. One thing I want you to understand before you start trading that I think you should know and should maybe take notes on is that retail traders like you and me that draw our trend lines, resistance, support, all our indicators, which I don't use by the way, I trade on the naked charts, only make up 5% of the market. 95% of the market is the financial and big institutions with millions of dollars that are buying and selling billions and millions of dollars of positions in different areas on the market. So what I'm going to go through institutional structure. I'm going to go through supply and demand zone refinement. These are areas in the market where a lot of buyers and sellers are sitting, and we can utilize that to place our trades. And then I'm going to go through Wyckoff and double MB entries, which is refined criteria in our supply and demand zones, which will confirm our entries for our buy or sell with a certain type of distribution and accumulation in the market that we can see to confirm and place our trade. So it's super important that we pair all of these three together. You can't go and just trade market structure. You can't just go and trade supply and demand zones. You can't just go and trade Wyckoff. You've got to pair up all three of these in one ideal strategy. So that's what I'm going to go through today. So if I come over to the charts over here, this is tradingview.com. I'm just going to come over to, let's take NASDAQ, for example. I've been trading a lot of NASDAQ. I'm going to clear the chart. I'm going to remove my indicators, and I'm going to start over completely for you. So the first thing you want to do is you want to come over to the daily chart. So when it comes to structure, you will have some kind of structure like this in the market. You've got a higher low, higher high, higher low, higher high, higher low, higher high, higher low. There may be a lower high, lower low, lower high, lower low, lower high, lower low, from bullish to bearish. Now you've got to remember, a market will never ever look like this. So although the market may look like this on the daily chart, if you refine maybe down to the 4-hour chart, you're going to have more structure within structure. So you've got higher high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and then maybe a higher high, higher low, higher high, higher low, higher high, higher low, and so forth until structure changes and until structure changes. When it comes to structure, you want to highlight the different points in the charts. So just you can create like a little circle, lower low, higher high, lower high, higher high, lower high, higher high. So when you're busy analyzing structure on the daily, you can expect, for example, if you're seeing some kind of pattern like this with higher highs and lower lows, you can expect the market to never come below this point over here. This area may be tapping in demand zones here, which is areas we can go and look for buys. But you've also got to keep in mind within the 4-hour chart, if you refine down to a 45-minute chart, you will notice there's more structure within structure. We've got lower lows, higher highs, higher lows, etc., etc. So the idea of market structure is to get an overall bias of which direction the market's going, where we can catch onto buys and sells, and which zones we can plot out on the chart to start looking for potential trades. So this is where, after structure, we can go and have a look at supply and demand zones. So in a nutshell, a supply zone is an area in the market where a lot of sellers have entered the market and when there's a lot of money sitting in the market. So at unmitigated supply zones, the market will always want to go tap into those supply zones and continue its movement further. So for example, let's go over supply zones first and then I'll explain demand zones. So over here, back in the 2nd of September 2020 on NASDAQ, we had a leftover unmitigated supply zone. So as you can see, a supply zone is the last up move before a down move that hasn't been mitigated. Mitigated means it traded out of the supply zone and never retested it until the 14th or the 13th of October. You can see it wicked into the supply zone and continued for further movement downward, providing good opportunities for a sell. And as again over here, in November 2020, it wicked again further into the supply zone for further movement down, but you can see there was not really much power in this wick because it already had been mitigated back in October. Same thing with demand zones. A demand zone is a last down move before an up move that hasn't been mitigated. So let me go find an example over here for you. So over here, for example, take this black candle. You will see this is a demand zone. Last black candle or the last down candle before an up move never came back to retest the market until about a week later in the 3rd of June. It tapped into the demand zone and continued the move higher, a good zone for buys. And you'll see over here, this was a supply zone where the market tapped into to move down into the demand zone to continue higher. So this was a good area for a potential sell. Remember, from here, this is the daily chart, to here is over 400 pips. That's a very good sell. And over here was a good opportunity for buys. This is also a demand zone. So this is where it can get confusing. So over here, although this is a green candle, this wick over here counts as the last down move before the up move. You'll see if I actually highlight this area like that and I come over to a 4-hour chart and refine, that wick now becomes a last downward candle. So let me go show you over here. Just trying to zoom in. Here you can see it forms into this wick over here. So that becomes your demand zone, and you'll see the market never tapped into this demand zone. I'm just going to stretch this demand zone all the way out. You will see the market never tapped into this demand zone from May 2021 until 24th of Feb 2022. And take a look at this. Market tapped into it, formed an excellent opportunity for a buy. So what I usually go and do is, when refining supply and demand zones, I like to go place my daily demand zones. So over here, if I come back to the daily, I'll look for my long-term daily demand zone. So over here, okay, you'll see this demand zone here has been mitigated. You'll see this demand zone over here doesn't count because it's been mitigated. How this works is, and what I mean is, you'll see over here, the market traded out of this demand zone, making it invalid, came back down here, retested it, continuing the move up. So although this looks like one blue candle on the daily, remember on a smaller time frame like the hour chart, it will look like this. So yeah, you've got your demand zone, you've got your candles forming out the demand zone, and it will come back and retest it for the move higher. Okay, that's a terrible illustration, but just remember, on an hour chart, this is probably like 50 candles retesting into the demand zone, so that's why that doesn't count. But an area that does count is this last down wick over here that has never been mitigated, because although this is a green candle, it's the last down move before an up move that on a smaller time frame would have been a red candle, a red down candle. So again, we can click on settings, We can have a look, just stretch this out. I usually just use 2000 and it stretches it out. It's called a Gann box, by the way. And we'll have a look if this market's never been mitigated. Okay, so it hasn't. So what I would do is I would then go and put a notification here and add an alert. As at this areas, I will start looking for buys. And then what I'll do is I'll go and identify my daily supply zones. So over here, I've got a supply zone, the last up move before a down move that broke structure. So if I click on my template supply zone, I like to keep my supply zones green. We can delete this demand zone because it's now invalid. So at these areas, I'll look for buys. At this area, I'll start looking for sells. And you will see this is an unmitigated demand zone because over here, we traded out of the market and we've never come back to retest it, fulfilling the supply zone. So that's why the supply zone is still valid and valid to look for sells. Then what I'll do is on the daily, I'll come back to 45-minute chart and I will go and have a look at short-term supply and demand zones. So over here, we have a supply zone that is unmitigated. And down here, we have a demand zone that is unmitigated. So let me just go template, demand zone. You can see this is the last down move before an up move that has never come back to retest it. So at both of these areas are valid opportunities for buys and sells. So that's step 2 complete, finding our supply and demand zones and refining down to them on a smaller time frame. I usually use my 1 daily chart and then my 45-minute chart to find short-term supply and demand zones to find short-term buys and sells. And then thirdly, we need some kind of entry criteria. We can't just buy when the market hits a demand zone or sell when the market hits a supply zone. And fourthly, that I want to add to this course, the most important part of this course is risk management. I want to show you a trick at the end of this video, a risk management trick that I use to turn losing trades into profitable and winning trades, and to how to really increase your win rate with trading. So let's continue with identifying possible entries and confirmations on our supply and demand zones. One thing I want to explain to you and help you with, if you're still watching this video, which I hope you are, is how to not miss out on trades, how to avoid FOMO, fear of missing out on the markets, how to not emotionally make poor decisions on the market that can lead to unnecessary losses. What I will do is when analyzing a market, I will only trade when the market hits my points of interest. So in this case, my supply zone over here and my demand zone over here, I will only look for entries and potential trades when the market is in my area of interest. Like right now where it is, I won't make any trades. I'm not interested in trading. We don't need to rush. We just wait for our market to enter a point of interest. And that way, it really disciplines you when it comes to trading. It's only trade when the markets hit your point of interest, which stops you from forcing trades and making poor emotional trading decisions. So over here, all I would do is I'd set an alert, for example, by the supply zone. I then set another alert by the demand zone. And then over here in these areas, we can start looking for entry confirmations with what you call Wyckoff and double MBs. So I want to go over what Wyckoff is, how it can benefit your trading career, how you can refine trades all the way down to 50 RR trades, how the banks move the markets on purpose to kick out retail traders, how accumulation and distribution works in the market by the big institutions, following their footprints, and how you can enter trades along that. So the first thing I want to go over is this website over here. Come over to school.stockcharts.com and you can just search the Wyckoff method. The whole distribution and accumulation method called Wyckoff was invented by a guy called Richard Demille Wyckoff, where in the early 20th century, in the technical approach to studying the stock markets, he considered one of the 5 titans of technical analysis, along with 4 other guys, and he observed numerous retail traders being repeatedly fleeced. Consequently, he dedicated himself to instructing the public about the rules of the game. So this entire strategy is what you call smart money. So this is where the whole idea of smart money concepts in trading actually started. He has a 5-step approach to the market. So he determines a present position and a possible future trend of the market. That's what Wyckoff will do. It will help you identify, for example, from bullish to bearish trends. And this doesn't only apply with stocks. This applies with any market that has buyers and sellers. could be, for example, Luna coin, which currently hit 0%. You will see the reason for that dive right at the top before Luna hits 0% from like $100 per coin is some kind of schematic of Wyckoff form, showing you that all of the buyers and the big investors in the market pulled out, hence why that market dived completely. So this works with anything, with crypto, indices, forex, stocks. It works with any market where people are buying and selling, and with any market that has any type of candles. So I want to go over the first step of Wyckoff, which is called the accumulation phase. So over here, we will have bearish, 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 Wyckoff play out, back to bullish trend. So this, in a nutshell, is a series of phases that turns the market around. So firstly, in a bearish event, we have a preliminary support, which I'm going to go over the market now and mark out everything for you. But this is super important to watch this and understand this if you want to get this right. We've then got a selling climax. So a preliminary support is where substantial buying begins to provide pronounced support after a prolonged down move. That's your bearish down move. Volume increases and the spread widens, signaling that the downward move may approach an end. We've then got a selling climax at the point which widening spread and selling pressure usually climaxes, or panicky selling by the public is being absorbed by larger professional interests at or near a bottom. Often price will close well off the low in a selling climax, reflecting the buy by these large interests. These large interests being big financial institutions. We've then got an automatic rally, quite a big move up. So the automatic rally occurs because intense selling pressure has been greatly diminished. A wave of buying easily pushed prices up. This is further fueled by short-term covering. The high of this rally will help define upper boundary of an accumulation TR. So for example, this is actually a really good idea. Let's say we're at a zone of resistance over here, or support, sorry. So we hit a zone of support. Most people on the AR, when the line hits that support, start buying. They're seeing the green candle going up. Retail traders start buying. And you would have probably noticed, if you've traded like this before, you set your TP quite high, stop loss below the low, and immediately it just taps down straight into your stop loss. And then over here, people see a break in resistance, start selling, and then it breaks into their TP, continuing higher. And it leaves retail traders thinking, what the heck just happened? Now, this is exactly what happens and why it kicks out retail traders. So after the AR, you're going to have an ST, which is a test on the selling climax called the secondary test. This is where price revisits the area of the SC to test the supply or demand balance at these level. If a bottom is to be confirmed, and volume price spread should be significantly diminished as the market approaches support in the area of the SC. It is common to have multiple STs after an ST. So you've got an ST here, you've got an SNT in phase B. The SNT in phase B always needs to go lower than the SC and the ST to kick out buyers in the market, hitting their stop losses or buy orders. And that way, the banks or the big institutions buying and selling millions in this market will collect all of those losses. That's where your money goes when you lose trading, by the way. Will collect all of those losses for a bigger move up, causing your sign of strength, which usually goes above the AR. So this now kicks out all the sellers selling over here at this break of resistance or support. We then have a bigger move up, clearing the AR, collecting all the liquidity there, and people or retail traders selling there. And then we have a fourth move called the spring, which clears out the S&T in phase B. And then we've got a secondary test on the spring. Now that test on the spring is my confirmation for my buy in an accumulation phase of Wyckoff. Now, I will only consider Wyckoff entries when we get into demand zones. Now, one thing I want to explain is this phase over here. There's another phase over here for distribution Wyckoff from bullish to bearish, which I'm going to go over in a bit. It's basically the exact same thing, just flipped around. It happens everywhere in the market on any time frame. So let me go over. Let me come to the 1 minute chart on NASDAQ over here. Wyckoff happens over here. There's Wyckoff over here. There's Wyckoff over here. There's Wyckoff over here. There's Wyckoff over here. Let me go and label it for you. So for example, over here, we were coming up to a potential demand zone. You'll see over here is your last down move before the up move, a demand zone, which hasn't been mitigated. You'll see over here the wick ends at the top of this red line. It never came back to retest it to continue the move higher. So over here, which was about 6 hours later in that day, we had a mitigation into this demand zone for the continuation higher for a perfect buy. So over here within this demand zone, you will see a market will never tap into a demand zone and just go straight off. It will form some kind of Wyckoff schematic. So if I go and open this up, you can have a look here and see how similar this is to this. So let me go and lay it out for you. Over here, we've got a preliminary supply. At this point here, you can see the market is starting to get some buying power. We have a selling climax over here. The last down move before another big up move. We then have our automatic rally over here, the immediate move up. We then have our SNT in phase B. So this move down here is our ST. We then have another move clearing out liquidity on the AR, and then a bigger move down, which is your SNT in phase B. This collecting liquidity by breaking the lows of the SC and the previous ST. We then have another move up, collecting more liquidity, and then we can expect a bigger move down, which over here is our spring. And then what I would go and do is to go and identify my entry criteria is I would go and use the double MB strategy. So an MB stands for a MentFX block. I learned this from the mentorship I took with MentFX. It's on YouTube. Excellent mentorship program. You're welcome to go and check that out. And this is how let me just correct spelling over here. This is how a MentFX block works for an entry criteria. So we basically just take a square over here or a rectangle on our tools. We want to draw after the spring a block around the last low to the high. You can see this is the last low to the high. This is some kind of demand zone. We then have a break of this demand zone or this ment block, a tap on an unmitigated demand zone in the spring to continue higher. So this high to low forms a second MentFX block. So now we've got a double MB. As soon as the third one breaks, over here, that confirms we've now gone from bearish to bullish. So this would be my confirmation for my buy. The second move into this MB, I would take my long position from 50% of this ment block like this. So my entry would have been there, stop loss below the low of that ment block, and I would have taken this market up all the way to the nearest unmitigated supply zone. Here's the last up move before a down move that hasn't been mitigated. This one doesn't count. You'll see it traded out of and remitigated it here. So I'm just going to quickly make this my supply zone. If I stretch this out, you can see again over here, Wyckoff played out. So my buy would have been all the way up to the supply zone, and we would have ran a beautiful 1 to 10.3 RR risk to reward ratio. So now what I'm going to do is, now that you understand how Wyckoff works, I'm going to do some back testing live for you. I'm going to go and click replay on a random point in the chart. I'm going to go over different supply and demand zones, identify Wyckoff and play some trades for you and back test, and we can work out our win to lose ratio. All right, so what I'm going to do is I'm just going to come back to any other random point. As this point, when I keep playing the replay tool and refine down on a smaller time frame, it gives me an error saying there's no recorded data for this time frame. So I don't know why it's doing that, but that's okay. All I'm going to do is I'm just going to refine maybe to a later stage at a random point. Let's go a random point over here, for example. Let's just click there. And what we want to do is we then want to come over from a 45-minute to maybe a 3-minute time frame to go and refine. When using time frames, I usually use what you call the 3-minute rule. So if you're on the daily chart, you want to turn that into hours. So that would be 24 hours divided by 30. That means you need to refine on the 0.8 hour chart, which would be the 45-minute chart. You then turn 45 minutes into seconds, so times 60 is 2,700 seconds divided by 30 means you need to now work on the 90-second chart, which is the 2-minute chart or the 3-minute chart over here. So over here, I've gone from daily to 45 minutes to 3 minutes, and let's go and refine. So I want to go and look for potential demand zones. If we come back over here, we can go and look for demand zones. You can see the current market prices here. There is a demand zone over here. You'll see this last downward candle before the big up move, breaking structure, but it has been mitigated. And if you look very carefully, you'll see over here, if I draw a line from that wick across, you'll see it traded out of the market, tapped it over here to continue moving higher. So this does not count as a demand zone. This little down move here on this wick counts as a demand zone. So although this is a green candle, again, like I've been explaining, this is the last down move before an up move that broke structure. So this would count as an unmitigated demand zone, as this wick over here never tapped this unmitigated area, which counts for a potential mitigation in the future. So I'm just going to go and make this my demand zone. Let's just go and stretch this out. And again, remember, we're just doing back testing. We're identifying our supply and demand zones for potential opportunities to buy and sell. So let's just leave that there. And over here, where we are now, we're actually very close to this demand zone. We want to go and identify our supply zone that's unmitigated. So over here, we have an unmitigated supply zone, template, supply zone. You'll see this is the last up move before the big down move that broke structure over here. So that counts as our supply zone. This is a supply zone over here that counts, but you'll see the market's busy mitigating that right now. So we won't look for sells over here. So at this point in time, where this market stands, I will only wait for the market to hit one or two of these interest areas, my points of interest. I won't trade the market until it gets to one of my areas. So let's go play the market ahead and have a look at where we get to. Okay, so we've tapped into our supply zone. Let's go and identify Wyckoff and see if we get an entry confirmation for a sell. I've just refined down to the 1 minute chart so we can see the candles better and see the potential points in Wyckoff. So over here, we're now going to have a distribution Wyckoff event. So it's the exact same as an accumulation phase, except it's just flipped the other way. So we still have our last preliminary supply. Instead of a selling climax, we have a buying climax. We have our AR, our ST, sign of weakness that clears the AR, a UT that clears the ST, another move down to test the sign of weakness over here, then back for the UTAD test, and my confirmation for my sell is the test on the UTAD. So let's go and look for this kind of schematic in our supply zone over here. So over here, we might have our preliminary supply. Over here, we could have our buying climax. We could then have our AR over here. So that being our AR. This move here could be our ST over here. We haven't had any kind of sign of weakness, so let's go and play to see if we get any sign of weakness. It needs to break the AR, so I'll put a line here. We can say here, BOS. Okay, so we've now had a sign of weakness occur, so that's broken the AR, so that would be our sign of weakness. So this point over here would be our UT. All we would look for is then I'll highlight the entire supply zone of this UT over here, and we'd look for some kind of test into this UT. So the UT supply zone counts as the entire down move to the up move that clears these highs. So it actually goes from there already, but I'm going to take it from the green candles. We want to look for some kind of test. So let's go and add a short position here. Our stop loss above the supply zone, above that high. And let's go and see if we get tapped into our trade. So I'm just going to go and click next. Okay, so we've now tapped in. Still a break even, still a break even. Okay, so we're coming into nice profits. Let's go and have a look at this point over here. When we form a double MB, remember the double MB rule, we have over here MB1. This would be MB2 has formed. Now, as soon as we break the second MB, we set stop loss to break even. and take partials so that it's a profitable and risk-free trade. So let's continue this trade to see what happens. Okay, so it wanted to test the UT again. So this over here would have been your UT or UTAD, the UT test. And over here, we've had a break of our double MB, broken structure. So now we set break even, close partials. It's a risk-free, profitable trade. Let's see if we get to TP. We continue. Okay, so we came back to break even, and that's okay. We've made profits, which is good profits. This is nearly 100 pips just on this move on our first position. Our second position is just break even. There's no risk. So this is a really good trade. And the reason why we can turn losing what would have been losing trades where most people would have just held until TP hits, and if it hits their stop loss, they look for a better trade. But because we took partials and broke even, it's a risk-free trade. We've now turned a potential loss into only guaranteed profits. And that's where risk management is so important when it comes to trading. So over here, I still think this was a very good trade. We caught a good move down, maybe didn't hit TP, but we still closed good profits and broke even. So again, we just go and reanalyze. This supply zone, if we play the market more, yeah, you see it broke straight through. So this broke our setup, which is okay. We would then go and just clear everything. Or if you want to leave it here to document your trading journey, you can go and do that. So let me actually just leave all of this here. We want to go and look for the next unmitigated supply zone that we can look for potential sells. As remember, the only demand zone or area that I'm going to look for buys is my point of interest over here. I'm not going to look for buys anywhere else. So I'm going to go and have a look here. Let's have a look. Okay, so this is a good supply zone here. This is the last up move before a down move that broke all of the structures. So this counts as a completely valid supply zone. I'm just going to go and stretch this out to 2000. So it stretches across the market. And over here, we are actually very close to our supply zone. So we can already start looking for Wyckoff. So let's go and identify our preliminary supply. So that would be over here. As you can see, we had an up move before a down move, showing that there's some kind of selling power entering the market. So this becomes your PSY. You then have your buying climax over here, BC. Then you have your AR, automatic rally, some kind of move down, which would be here, automatic rally. We then want to see the ST, which could be over here. That's your ST. Let's continue playing this market out to see what it gets to, what it gives us. Okay, so this would be your sign of weakness, breaking the AR and the BC and the ST. So this is your sign of weakness, which is exactly what we want. We've then got our UT, so we need a move that breaks the high of this BC. There we go. Perfect. So this is your UT. Now we want to look for some kind of test on this entire UT. So over here, we've got the UT candle. We want it to break this UT and retest it for the continuation down. So let's have a look if we get that. Okay, so we've now broken the UT. I'm going to put my sell entry over here, just next to this black candle, stop loss above the high. We can take our TP to the next unmitigated demand zone. But if you have a look over here, there's another demand zone over here. This counts as a demand zone because it's the last down move before an up move. I would take partials here and set this as TP1 and make my final demand zone TP2. So let's go and have a look if we tap into the trade. Okay, so there we go. It's gone up. It's tested the UT. We've now entered the trade. Let's have a look at where we get to. Okay, so over here, we have our double MB, last down move before an up move. So this is your last down move before an up move. That becomes block number 1. We have another that breaks it. So this becomes your new MB, the last down move before an up move. And we broke MB2 over here. So now we break even, we close partials, risk-free trade. So again, that's technically 2 out of 2 wins so far. Let's see if we hit TP. Ah, perfect. So this was actually a TP hit trade. You'll see if I just move my thing back there. You can see that's a TP hit trade. So this was a very good trade. Perfect Wyckoff schematic over here. We have our UT, a test on the UT, which I entered on that wick, perfectly down, straight to TP. So this is how backtesting works. You literally do this for hours on end, practicing your Wyckoff, your supply and demand zones, identifying your structure. You'll see at the moment, I'm looking for sells because understanding we're in a bearish market. So I think we'll definitely catch bigger sells in this market than buys. So over here, let's go through this one more time just to show you how backtesting works and how often you can go through it. So let's keep these trades over here. Remember over here on this test on the UT, we can say we had BE over here. So we're just going to leave that there. We can leave our trades there because remember our take profit was this demand zone down here, but we went back to break even. This trade was a TP hit over here where I entered on the test of the UT. So we can leave this here as is. Let's just make this nice and thin so it doesn't get in our way. But that was a TP hit. So this can be a +1 win. This can be a plus 0.5 win, which stands for partials taken plus BE. So that's good. We're only on wins so far. And over here, we can start looking for Wyckoff on this demand zone. Firstly, we want to identify the last unmitigated supply zone, which in my case, the one that broke structure, I would say there's two of them. There's one here. Let me just turn this into a supply zone. Template supply zone. There's another one over here. And supply zone. We can delete all these other supply zones so it doesn't confuse us because those have already been unmitigated. There we go. So this would be TP1, TP2. And let's go and identify our Wyckoff. So over here, we've got, as we get close to the demand zone, I would say over here, we've got our preliminary supply, which in this case, over here, your preliminary support or supply. You've then got your selling climax, which falls over here. So you've got a selling climax. You've then got a move up the AR. You then want to look for your ST or your SNT in phase B. So this over here could have been your ST, which another move up and then a big move down. So I would call this over here your ST. You'll see on like a second chart, it will look more refined, but this move down counts as your ST. It's very difficult to put it there. And then a move up, then a bigger move down, forming your SNT in phase B. As remember, the SNT in phase B needs to clear the SC and the ST. We then have a move up to test the AR. So let's go and have a look and play this one more time. Okay, so there's your test on the AR. We can now expect some kind of move, a spring move that beats or goes below the ST. So let's have a look. Okay, so in a case like this, when you don't have any test or any SNT in phase B, the whole Wyckoff schematic was actually within here. So if you go on a very small time frame, and this is where the seconds time frame can help. If I go on the 15-second, I'm pretty sure this time frame is going to mess up. So let me just put like a big heart here to know where I was. You'll see if I come over to 15%, it gives me this data point unavailable error, and I don't know why it does that. So I'm unable to test on the second time frame, but that's okay. All right, so like I was saying over here, within the schematic over here on a smaller time frame, like the 15 or the 30 seconds, which for some unknown reason keeps resetting my chart. But the whole schematic of Wyckoff over here, so this would have been your selling climax, this would have been your AR, this would have been your SNT, this would have been your SNT in phase B, back for the test on the AR. This over here would have been your UT, and then I would have looked for any kind of test on this unmitigated UT. So I would highlight this entire demand zone. Let me just bring back the candles a little bit over here. Although I'm replaying this now, I personally would have missed this trade as it's very difficult unless I was able to get onto the 15-second chart, which you can do in the live market. So I'm going to make this my demand zone on the UT. I would then enter my buy position here, stop loss below the low. I then take TP to the nearest unmitigated supply zone, so that being TP1, and then TP2 for our target over here. So let's go and have a look at what happens with this trade. Okay, so we've now tapped into the trade. So stretch this out and watch it as we go. Okay, so here we have main block 1. We have main block 2. As soon as structure breaks this high over here, like that, we set BE and take partials. Okay, so there we go. So now we set BE, break even stop loss, take partials on the trade, and let's have a look if we get to TP1. Okay, perfect. TP1 was hit, so that's take profit hit. So we've closed in partials. Our first TP is hit. Let's say we've got one more position, set at break even, set for TP2. Let's see what happens. Okay, and there we broke even. So this was still a fantastic trade. We hit TP1, we broke even, took partials. TP2 could have been excellent profits if you closed manually, but I would not do that. I would trade according to my system. I would have held until TP, knowing the rest of the trade is safe. I've closed partials, hit TP1, and break even set. So this we can call plus 0.75 because we had partials taken and TP1 hit. So this was another winning trade, and you'll see we haven't had a loss so far. So in this case, now that we've broken this demand zone over here, we want to go on a higher time frame, for example, the 30-minute or the 45 minutes, come all the way across and have a look at what other unmitigated demand zones there are. So for example, I wouldn't see any here. This doesn't count because the market came out and retested it here. If we have a look here, this doesn't count because this big black candle, you'll see, market traded out of it and retested it. However, this area here counts because on a smaller time frame, this is down red candles. This last down move before the up move, breaking structure. So this would be another zone that I'd stretch out like that we can look for potential buys or sells along the way. So over here, we can mark a supply zone. None here, none here. There's one up here that we can mark, and you only trade the market. Sometimes you're going to have to be patient when the market gets to these areas. So I really hope you got tons of value from today's video, and I want you to comment down below if you want to see more videos like this. Just back testing in this session, I was able to make 4 winning trades, which one was break even and partials, 2 was TP hits. The last one we had over here was TP1 hit, break even. And those 2 trades that we broke even, which for maybe normal retail traders that would have been losses, for me ended up being profitable wins. That's where risk management is so important with trading. Same with your risk to reward ratio. As you can see with Wyckoff, we don't really get any trades that are under 1 to 7 RR, which is a fantastic reward to risk ratio. And you can obviously do the same thing if you want to catch bigger trades on the daily time frame. You go and identify demand zones, like maybe there's one over here, and you take this market all the way up to the next supply zone. Again, confirming with Wyckoff on maybe a 10-minute or a 5-minute, and you can enter your trades. And I mean, this buy over here on this demand zone was 12,000, over 4,000 pips on this trade, which is absolutely huge. So what I want you guys to do is on the second YouTube channel, I've really posted as much as value in today's video. I want you to go down below, subscribe to this YouTube channel with the red notification bell on, comment down below that you're ready, and I will give you access to my entire trading playlist on my YouTube channel, my main channel, which I'll leave a link to your comment and I'll reply to that. So make sure to be tuned for tomorrow's video. I'm going to go over some more sniper entry criteria and different trading criteria. If there's anything you want to know specifically about trading, comment down below. If you want to learn more about affiliate marketing, drop servicing, funnel building, then I recommend follow my main channel, which I'll also put a link down below. But take care and I'll see you in tomorrow's video.